Check.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the Thursday edition of the Real Investment Show. Second best day of the week, of course. Michael Liebowitz joining me today. Of course, today now, the election behind us, we now have to deal with a lot of economic data out today, as well as the Federal Reserve this afternoon. So we will get an announcement around 2 o'clock this afternoon on the latest Fed rate cut announcement. Right now, it's about a 96% chance that they're going to cut rates by 25 basis points. There's really nothing in the data that suggests that's going to change. And, so again, when we take a look at recent data, it's really not pushing in a direction that says the economy is just really kind of falling apart. And so they need to be more aggressive. At the same time, there is some stress. We are seeing some issues, right, with the markets in terms of recent employment reports, although those were affected by, the hurricanes, also the Boeing strike. But again, there's enough weakness in some of the data that certainly suggests another 25 basis points is going to be likely. And again, the Fed wants to get the Fed funds rate down closer to the inflation rate ultimately. So again, those should be fairly close together. So policy's a bit too tight here. So the Fed's going to try to bring that down. But anyway, we'll see that today. Probably get the same type of FOMC announcement that we get every meeting, which is they're being data dependent. They're watching the incoming data flows. They'll adjust their rates accordingly. But again, there is the risk of a surprise, right? If they come out and say, well, maybe we're not going to cut as much as we thought, or whatever it is. And we'll also start to see kind of a look towards the year end as well. So again, certainly something could come out this afternoon, a statement that could certainly kind of spook markets. We'll see what happens. But right now, futures are pointing higher. Here's the problem that we have from yesterday. And I shouldn't say it's a problem. It's not really a problem. But we talked about the market was de-risking going into the election, and we'd held this 50-day moving average support level. So, that was all fine. But we've got a lot of aggressive positioning now in the markets. So for investors, one of the big challenges right now is going to be getting into the market. So if you are out of the market, trying to wait till after the election, this is why I wrote a piece last week talking, in last week's newsletter saying, hey, I'm not doing anything till after the election. Well, here's the problem with that, and I warned about this last week. The problem with waiting until after the election is now trying to figure out what to do and how to get into the market, because now the market was up nearly a little over 2% yesterday for all the major indexes, the S&P, the NASDAQ, and the S&P 500. The Russell 2000 was up almost 5.5% yesterday at the close. So again, huge jump there. And small caps have finally broken out to a new all-time high going since 2022. So it's been a very long road back to break even for small cap investors, but finally got that yesterday. But this is the problem. So now getting into the market is going to be the challenge. And this is where you're just going to have to use a little bit of grit, and you're just going to have to buy it. Unfortunately, that's just kind of where we are right now. Now, in a second, we'll kind of go through the technical setup. We're going to get some pullbacks here. We're going to get some little dips. We're going to get some little corrections and those type of things. But they're going to be short-lived. You may get a sell-off that lasts a day. And you're going to have to try to use whatever little dips you get just to buy into positions. But again, this is where investors get psychologically trapped more often than not, because they're like, well, now it's too overbought, I can't buy it. that's the risk, right? We had this correction, and this was kind of the opportunity here to get some exposure, but there was just this lot of concern about, the election, what happens, who wins, all these type of things. But again, market was setting up for this type of move. So again, just now you're just going to have to step in slowly. Just take small bites. Again, don't try to just lever your portfolio all up at once. That's never a good thing. But yeah, you're going to have to just step in today and just buy a little bit today. Step in tomorrow, buy a little bit tomorrow. Step in next week, buy a little bit more. And then if you get little pullbacks along the way, and again, when we get into December, the first couple of weeks of December, markets, mutual funds have to distribute all their gains and taxes and distributions for the year. So you typically get a little bit of sell-off in December before the Santa Claus rally. So there'll be some opportunities, but they'll be very short-lived. So here's what you need to know before the bell this morning. S&P, like I said, broke out to new all-time highs yesterday. That sell signal we've been on for the last couple of weeks now very close to reversing. When we get this reversal, and which will probably happen today, actually, that will be the kickoff for the seasonally strong period, all in total. So we have the weeklies in place. Now you have the dailies in place. So again, this is going to potentially push markets higher here over the next couple of weeks. Now here's the important thing, though, that we've kind of been talking about as of late, and we've got to kind of keep a watch on this just a bit. This kind of trend line that we've got running from these August lows is going to intersect right around 6,000. My line's not perfect, but just trust me. We're coming up on the bottom side of that right now, and we're going to try to gravitate up towards 6,000 by the end of the year, maybe a little bit higher. But again, this is kind of this trend line we've been talking about. So it's going to act as resistance right now going into the market today. The market's going to rally a little bit today. We'll see how much it can hold on to that rally. We may get some profit taking today. So I wouldn't be surprised to see a little bit of a strong open, a little bit of a sell-off maybe later into the day. But markets are back. We know that oversold condition that we had very briefly was completely reversed yesterday. So again, we're back to overbought here real short term, but that can stay overbought for a while, particularly when there's a lot of momentum. Hedge fund managers are very underweight equities going into the end of the year. They've got to get grossed up on their books. So that kind of that systemic positioning for hedge funds, professional managers, etc. They de-risk going into that election, and now they're going to have to get re-risked by the end of the year, and their portfolios have to be allocated by year end. So again, there's going to be a lot of buying power between that and corporate buybacks, which is going to run about $6 billion a day here over the next 2 months. 21% of all buybacks, as I've told you before, get done over these 2 months. So again, there's going to be a lift to the markets here over the next 2 months. So again, don't try to fight it, but be opportunistic about getting money put to work. Speaking of small caps, they've, as I said, they finally broke out. Huge day yesterday for small caps. Finally broke out of this massive consolidation that they've been in here for a while. But you've really got to go back, unfortunately, quite a ways to really kind of get a picture of what's been going on for small caps. They finally broke out of the January 21 highs. So again, it's been a very long haul for small caps and a big underperformer. That's been a huge drag on portfolios if you're a small cap or have a lot of small cap in your portfolio. But you're now starting to get a little bit of exuberance. As we talked about yesterday just briefly, there's a very high correlation between the NFIB annual rate of change in the index for the NFIB and the annual rate of change in small cap stocks. The Trump election is going to be very beneficial, very positive for the NFIB index. I would expect a very big jump in that index in the next report over optimism about the outcome of the election. That's going to translate into higher prices for small and mid-cap stocks. So again, they're not grossly they are very grossly overbought after yesterday, but they're turning up on a buy signal here as well. So again, pullbacks in small caps, mid caps, you may want to look at adding a small bit of exposure. Now, there's still a lot of risk to that sector. About $60 billion worth of corporate bonds are going to get downgraded to junk next year. Most of those bonds are in that sector. So know what you own, be careful what you own, but there's probably a need to add 3 to 5% of small mid caps to a portfolio here over the next year. We're going to be monitoring this kind of closely, but again, don't take a lot of risk, but you could see a little bit of more of a beneficial play in this sector now. That's what you need to know before the bell this morning. We'll come back, pick up with Michael Leibowitz, talk about Fed, gold. Got a lot of stuff to get into this morning with him. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. My mic was turned off. That was probably a good thing, actually. We'll just sit here and listen to music. Seriously. I don't know who does these surveys and polls, by the way. There was this poll out this morning asking how often do you eat Mexican food, right? And the survey was that most people eat Mexican food at least once a month, right? Now, I don't know who these people... Brent's looking at me right now. He knows better. These people obviously are not married, and the people that they're interviewing are obviously not married either, because it takes tacos and margaritas at least twice a month to keep my wife from going feral. So,
Only twice a month?
at least twice a month, if not 3 or 4 times a month.
My woman goes every day.
That's okay. That's a little too much.
Tex-Mex, yeah.
That's a little too much. Yeah. But, once a month for Mexican food. I don't know where these people... Obviously, these people live up north somewhere where Michael Leibowitz is. So, where they don't have good Mexican food. See, Mike's never had good Mexican food. Go ahead.
A, I have, and B, probably every other week as well, Lance. It's nationwide.
You do not have good Mexican food up there in Maryland.
We do.
No, but when you come, you're coming. So, by the way,
I've been to the place with you.
I know. Well, see, that's okay. That's right. You had good Mexican food when you were with me. By the way, mark this on your calendar. January the 18th, we are going to have our next economic summit here in Houston. We'll have the details coming up here soon, but mark it on your calendar if you want to come. Mike's going to come down. I'll be there. Rich Rosso, Danny, Adam Taggart will be there as well. We'll probably have a guest speaker. Don't know who that's going to be yet. We'll think about that. But we're having some breakout sessions this time around as well to get very specific into specific areas. on investing, financial planning, et cetera. So anyway, mark it on your calendar, January the 18th. We'll have details up on the website here soon, which, by the way, we're also about to launch a brand new website. So we've got a whole lot of new stuff coming, especially as we roll into 2024, also with Simple Advisors as well, some new integrations coming out there also. Anyway, lots of stuff coming down the road. All right, Mike, let's get to the big stuff today. Obviously the election yesterday kind of sent markets kind of wheeling. We saw VIX get absolutely crushed. It was one of the biggest vol drops in a day that we've seen probably ever. It was a pretty amazing drop in volatility. It was interesting. We saw a lot of de-risking going into the election, a lot of hedging for the election, and all that got unwound yesterday with the results. The problem is now if you wanted to short the VIX, it's almost too late. So, I mean,
right.
It's investors that, and this is what I was saying earlier, we had warned in last weekend's newsletter about waiting till after the election to do something. And this is the consequence of it, because now it's very difficult to make those next steps because stocks are back to overbought. VIX has been crushed, so kind of what do you do from here is going to be the next question, right?
And I think the reason it got crushed so much is because it wasn't contested. I mean, Trump clear and away won the election. And I think a lot of people thought maybe Harris would win, maybe Trump would win, but the margin of victory wouldn't be that great. And you'd have these 4 or 5 states, the Wisconsins, the Georgias, that Pennsylvania, that it would be within thousands of votes and it would get contested. It's not being contested. Harris and Biden have talked to Trump. They've given it to him. So it's a done deal. And I think what VIX was really pricing in was we wouldn't know who was president for days, weeks, whatever it was going to be.
And you and I talked about this. I mean, we said, the big risk to the election outcome was not the election itself. It was that it wound up being contested for a couple of months and we wouldn't find out till December. So that there was kind of this huge relief in the markets, and we saw just a lot of re-risking happen very quickly yesterday, and the markets opened up strong, and then just kind of gradually ground higher, kind of all day, and they didn't end up a whole lot higher than where they started, but it was just a continual bid behind stocks all day yesterday. So. So I thought it was interesting, and again, what was interesting is it wasn't just every stock was going up. Financials did excellent. Technology did great, kind of those Trump basket type trades. But, we got over into real estate, utilities, some of the other areas. They didn't perform that well yesterday.
Yeah, it was for such an up market, it was a mixed bag. The heat map had, plenty of bright green, and actually the big tech ended up doing really well. At the open. It was it was up but lagging. It ended up catching up nicely, but there were pockets of red on the screen, pockets of kind of unchanged, and a lot of up. So again, it also argues for a diversified portfolio where you don't put all your eggs in a few baskets, where you spread it out. And if you had a Trump portfolio or a Harris portfolio, whatever that really means, if you had a portfolio with both, as we do, you did just fine. And, I think that it's another lesson in diversification and spreading your risks out, not just by asset, but within assets and industry and sector, et cetera.
Yeah, exactly. Interest rates took a big hit yesterday, obviously, just kind of a knee-jerk reaction to, potential issues with tariffs and those type of things. You also had a 30-year bond auction yesterday. Again, the action in one day doesn't really change the narrative of what drives interest rates long-term. But they responded very closely to what we saw back in 2016 when he was elected. Tax cuts, corporate tax cuts across the board, really. Kind of expectations of tariffs, which might lead to more inflationary pressures. All those didn't mature, last time as well. It's interesting. There's so many comments about, oh my gosh, if we put on tariffs, it's going to cause inflation. But nobody's looking back at 2016 when we had tariffs. It didn't create inflation. And that's because consumers offset prices. We talked about this on the show before. But again, the reaction by the bond market yesterday was extremely similar to what we saw back in 2016. and then rates fell after that. So, again, yesterday was just kind of this knee-jerk reaction. Bonds are extremely oversold, yields very overbought here. But what's your opinion? What's your take here?
You know what? You also got to, when you're looking back at 2016, you got to look at the starting point. Yields were very low back then. They're relatively very high today. Mm-hmm. So we're already starting from a point where where interest rates are restrictive to the economy. And now they're marginally more restrictive for the economy. And when we start talking about the Fed, that's an interesting point to remind me of, to bring up. How does the Fed react to that? But yeah, if you look at the other markets, gold was down, 3%?
Mm-hmm. Yeah.
Which is interesting. If it's so inflationary, why was gold getting crushed? And there were other indicators as well that just didn't jibe with the story. So I think some of the reaction yesterday was, Trump's going to win. He's going to put on tariffs. He's going to keep taxes low, and he's going to run these massive deficits. That's probably not going to, he's certainly going to do some of that, but the deficits part is a wild guess by the market and will probably not be nearly as wild as expected. But the market's got to settle in here. There's also some relief built into stocks and a hedge built into bonds that the election would be contested.
Right.
So exactly what we were talking about with VIX, you're seeing in stocks and bonds. It's not the end of the world. The sun rose today, and just like every day, and everything goes on. And the market didn't think that would happen. They thought that there wouldn't be a winner, and there wouldn't be a winner for weeks, or even it could go to the Supreme Court. It could go to Kamala Harris as vice president voting for it. I mean, there were all kinds of crazy scenarios out there. And given that the polls were so tight, it was really hard to decipher what would happen. And very few people said it would be a runaway like it was. Right. So, the market's adjusting to that fact, and it will adjust for the next week, few days, few weeks. But at some point, it's going to come around and really start looking at the fundamentals and facts again.
Well, and again, when we come back from the break here in a minute, we'll get into the Federal Reserve today, because obviously that meeting got delayed today because of the election. And I'd said this earlier this week. I think on Monday we were here saying, okay, we'll have the election on Tuesday and the Fed on Wednesday, and I forgot that they delayed it a day because of the election. So we'll actually have the meeting started yesterday. We'll have the results of that this afternoon. We've also got a good bit of economic data that's been coming out here. It's been overshadowed by the election, but we still have a lot of economic data coming out. The economic surprise index is very elevated. So we're also about to get into a period. We're about to start getting into a run of data that disappoints in terms of economic expectations. And this is the way it always works. Economists are overly optimistic, the data disappoints, so they get overly pessimistic, then the data outperforms, and then, which has been the case as of late. So that surprise index has had a very large rise. We're now to the point that we're likely going to start seeing more disappointing economic data. So as we start getting into retail sales and those type of things heading into the end of the year, that is likely to be weaker than expected. And that's an important point here. And Mike, I'll throw this back to you, but just because we had the election, it doesn't change the fundamental economic drivers of what's going on. And we have clearly weakening economic data. Just, it's great that we've got the election behind us, but whatever policies get enacted are going to take a good bit of time before they actually impact the economy. So we're going to have to deal with the real economic data that's going on relative to the markets and how we invest here. That's not going to change overnight, and those dynamics that are driving weaker economic growth are still in play. All right, quick break. We'll come back, pick up Michael Liebowitz. We'll talk about that as well as the Fed right after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the Insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
One thing that the consumer confidence measures, is that correct? If I say consumer confidence measures
squared.
How many measures can the consumer confidence measure? I don't know.
The Real Investment Show podcast.
Dr. Seuss.
The consumer confidence measures investor sentiment about stocks. That's the highest level on record.
Same show, your schedule.
It's amazing. Consumers are super confident about the stock market.
At realinvestmentadvice.com.
At the same time, they go, my life sucks economically, but the stock market, it's all good.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, let's welcome back to the show. Of course, Mike, I kind of left off with a comment, talking about that, despite the election yesterday, that we're still going to have to deal with the economic data we have right now. Today we've got initial claims, we've got, we had ISM services, which actually ISM services were fairly strong. I think those were out yesterday or day before. They were actually, very well on the services side, which is about 80% of the economy. So it certainly doesn't suggest the economy is slowing down. But we've got PMI today. We've got, for October, and we've also got the U.S., the global U.S. Economic composite out today. The Chicago Fed National Activity Index recently was very weak. So again, we still have to deal with the economy today. And as I was saying, is like, just because we have a new president, things just don't shift on a dime. Optimism will shift on a dime, and small businesses, as I said earlier, I think we're going to see a very big jump in the NFIB Confidence Index because of the election. Business owners tend to lean more conservative because of tax cuts, those type of things, which benefit their business. So we're likely going to see a very big jump in that data. But the rest of the data, employment, wages, those type of things, those are not going to change on a dime just because of the election. So we're just going to have to deal with that, and the Fed's going to have to deal with that as well. But your thoughts?
Well, first of all, remember that last month's employment report showed a rise of 12,000, 15,000 jobs. Now, there was hurricanes in there. There was other things. But if you really look at through the employment data, not just the Friday report, but the JOLTS report, it's not a strong labor market. It's not a weak, we're not going into a recession labor market, but it's becoming a very average market, if not slightly below average as far as job growth. And the job growth is weaker. It's part-time. It's not full-time. So, you can say, we're in a normal economy, and this kind of leads us to the Fed. Well, why is the Fed? Everyone's saying, why is the Fed cutting rates? What are they doing? Well, rates are at 4.75 in a 3% growing economy. That doesn't work for an economy that's heavily indebted. And eventually that will take a heavy toll on the economy. And what the Fed's trying to do is get ahead of that and try to bring them down before it takes a heavy toll. So, for instance, in 2025, there's what's called a wall of corporate debt coming. There were a lot of companies that refinanced their debt in 2020, 2021 at very low rates. A lot of those mature. Some matured this year, a lot matured next year and the year after. And if all of a sudden you have an interest rate going from 3 to 7%, something like that, that's an extra 4% off your bottom line that's going to have to be made up somewhere, right? You're going to cut employees, you're going to cut expenses, you're going to do something. So, and we're seeing it in the home building industry. Home builders, which were doing really well because they could offer lower mortgage rates than what was going on, just are not having any luck anymore. It's expensive to issue a mortgage rate below what the going rate is. So again, we're in a fine economy. It's an average. I would say it's an average economy, give or take a little. Your inflation is getting back to target, and the Fed is still at a high rate. And they know, and they remind us every single meeting, the lag effect still exists. I know it seems like a fairy tale at this point because it hasn't happened, but it is happening, and it will continue to happen. And now the Fed, Lance, if we go back and they cut at the last meeting, what's changed besides the political climate? Well, you have interest rates are now 50 to 75 basis points higher across the board. That's a big deal. So, this meeting, I'm going to move on to the meeting here. This meeting is very interesting. At first, it seems like a very boring meeting. The Fed's going to cut 25 basis points. They're going to be data dependent, and they'll lean towards cutting 25 at the December meeting. And, that seems boring. But I think this is one of those meetings where, assuming there's not a Fed surprise, reading between the lines will be very important. So, let's talk about the surprise first, right? They could either not cut, which would probably be interesting. That would be good for bonds because the bond market seems to be concerned that they're going to cut rates and stoke inflation. So in a weird way, long-term bonds would do well if the Fed doesn't cut, or they could cut by 50, which would probably stoke stocks and kill long-term bonds. But the Fed is really good about communicating. They don't want to surprise the market. The market, like you said earlier, is 96, 97%, the odds of a rate cut of 25. They're going to cut 25. But what we're going to look for in this statement are changes to the language around employment, around prices, around what they're looking for, what they're looking at, and particularly in Jerome Powell's press conference. What's he going to say about higher rates? Will he say anything about the Donald Trump presidency? And those will all give us hints about what the Fed's going to do. Because if it looks like the Fed's going to do 225s and stop, that has a very different effect on markets than a Fed that appears to want to just keep going down the 25 ladder until you get to 3%-ish. So even though it seems like a very boring Fed meeting that you could, you could pretty much guess what they're going to say. I think there's going to be some statements, some lines that will be very interesting.
Well, let's play a little bit of bond bull, bond bear for a second, right? I'll be bond bear and just kind of give you some of the more kind of recent comments. The Trump presidency is going to lead to a massive surge of economic growth, which is going to spark inflation, which is going to lead, push yields, dramatically higher from here. What do you say to that?
It might. But what's he going to get through? It's not just up to Trump. He has to get everything through Congress. And yes, it's a Republican. It looks like the House is going to be Republican. The Senate is Republican. But he has that Freedom Caucus that is very conservative and very fiscally conservative. And my guess is that they're going to push back on spending. So it's not quite as easy as you think. And tariffs are not necessarily growth inducing. Tariffs can be very dangerous, right? It's not just that we impose tariffs and everything's okay. Countries fight back and they then impose tariffs, and things can get very ugly. So we'll see what happens there.
Yeah, and again, I think there's a really important point about tariffs. Everybody's, this is one of the misnomers, I think, with the bond market in particular. Is that they're going, well, Trump's going to come in and just, inject a 200% increase in tariffs. That's the hammer, right? That's his hammer.
Right.
What's going to ultimately happen is he'll probably impose tariffs like he did in 2016, 2017, 2018. He put tariffs on China, but they were much less than what was expected because he used the hammer of big tariffs, and then there was negotiation. To get what he wanted out of that. And that's going to be the case this time as well. So yeah, we'll probably get some tariffs on China in particular, but they're probably not going to be nearly as onerous as the market's currently expecting, which, that's going to be, bond bullish.
And China's in a very bad place economically. So China's just not going to accept tariffs and just let it be and further hurt their economy. They will either let their currency depreciate, impose tariffs the other way. They have a lot of power. So this isn't just Trump being able to bully all these countries. Right. These countries do have power and leverage and will use it. So it's not, like you said, it's not nearly as easy as just imposing tariffs and prices go up.
Right. And so another bond, kind of the bearish argument for bonds is that, we're about to go back into 1970 style inflation. And this is going to lead to a massive, massive bear market in bonds. I've talked about this before, but your thoughts?
Yeah, I wrote that 4-part article on this whole thing, and there's so many differences, and it starts with the Fed, and it starts with the environment at the time. In the 70s, we weren't. It sounds crazy, but we weren't that far removed from the Depression, and what caused the Depression. And the big problem with the Depression was employment. The unemployment rate was over 20%. And, you've seen the pictures of the long lines of the soup kitchens and, anyone was willing to take any job at that point. So employment was always, in the 70s, was first and foremost and the only job of the Fed. And the Fed believed that higher employment, more people hired, would lower inflation. That's not necessarily true, as we've seen now. So they didn't care that inflation was going up while they were stimulating the economy with M2, with money supply. So that was a huge thing, was that the Fed was on the wrong playbook. Then you have Nixon made all kinds of mistakes, trying to set the price of goods. The price of oil, for political reasons, not economic reasons, shot through the roof twice. So, there's a whole host of things that will not likely replay this time around. There could be other reasons for inflation, but it's not going to be many of those from the 70s.
And I guess lastly, just here before we get to the break, just real fast, is that, the idea is that the Fed can only control the short end of the curve. But, if interest rates rise too much, again, the one thing that everybody kind of forgets is that we have so much debt, deficits, et cetera, that higher interest rates are really not sustainable long term. And the question is if the Fed can only control the short end, what can they do with the long end? We'll pick up on that when we come back from the break, and Mike's latest article on gold. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. So, Mike, just wanted to finish up that last conversation real quick. Fed controls short end of the curve, but can they actually impact the long end of the curve through other fiscal, monetary policy changes that they have under their control?
And that was a great point you brought up, Lance. Yes, they can, and they have. First of all, remember, they're doing QT. So they can stop QT today. That may be one of the surprises we see. They can do QE. They're not going to do QE, but that's another thing. So what's QE? They're buying bonds. They're actually buying bonds out of the market. That pushes bond yields down. And they can also do something they call Operation Twist, where they they could buy bonds and they could sell some of their short-term maturity bills and notes. So the Fed does have sway, but I think most of their sway is just in what they say and how they talk. And the Fed's aware of what's going on and will probably try to say or do something that's bond bullish, I would think.
Right.
They can't be happy with this increase in rates. And it's not just here, it's going on around the world. So it's global. And I'm sure there are a lot of discussions with other global central bankers. How do we stop this?
Well, again, I do, and it's interesting that the stock market so far has really ignored higher rates at this point. Again, it's only because interest rates really haven't gotten to any critical level at this moment. Interest rates are running about, not that far above inflation, not that far, above economic growth. So, interest rates are kind of where they should be. They're a little bit higher than they should be right now, but we'll probably, that's a lot of that's just been kind of knee-jerk reaction, kind of election issues. I think that'll fade off and rates will come back down towards kind of a more normal level. But even at these levels, you are having a very big increase in interest payments as a percentage of federal revenue for the government. And I am sure at some point there's going to be pressure from the administration on the Fed to bring rates down, particularly for financing debt, rolling over debt. Again, the Treasury's been doing a tremendous amount of issuance in short bills rather than long-term Treasury debt because of where interest rates are. And I'm sure they're going to want to get interest rates down at some point so they can refinance that debt out into longer-term maturities. But, we'll see.
Right. And Trump will push on that as well.
Yeah.
Right. Trump's not going to want to preside over a massive deficit either, even though that seems to be the conventional logic. Mm-hmm. And in fact, actually, didn't he put Elon Musk, who said he'll immediately cut $2 trillion from the spending, in charge of the deficit?
The Government Efficiency Department. So
right,
yeah. So there we go. But so let's. I don't want to burn all of our time. You have an article on gold out on the website, and I thought it was really an interesting article. It's something that I've talked about before on the show as well. But again, there's a lot of people that are long gold. We've had this massive, surge in gold prices, particularly this year. On a monthly basis, technically, gold is extremely overbought. And in fact, there's only been 3 other periods in history going back to the 1950s where gold has been this overbought. Technically, just on price move, it's never been this overbought before. But you kind of did a deep dive into gold today. That article on the website right now, by the way, at realinvestmentadvice.com. It's our featured article at the top of the Insights page. But what was your takeaway from your analysis?
So what was interesting is we've done some other work on gold, and one of our kind of core theses is that gold and real rates, so the rate of inflation of interest rates less inflation, are very highly correlated, especially when real rates are low. And so we went into this let's just forget everything and start over, and let's look at some core kind of economic factors in their relationship with gold. So we looked at M2, which is the money supply, CPI, inflation, real rates, and the dollar versus gold prices. And we looked at running correlations going all the way back to 1971. And we basically said for every month, what was the predominant relationship? And if there was no statistically predominant relationship, the answer was there was none. So what's interesting when you go back and look, that the nuns for both the positive and negative relationships existed for about 50% of the time. So gold is kind of trading on its own half the time. Other times, M2 on the positive side, M2 and gold have the most predominant relationship. In other words, as M2 rises, gold rises, money supply. And on the flip side, the dollar has the strongest relationship, negative relationship. So if the dollar goes up, gold goes down. And where this kind of led us to was, then what about stocks? And you can see now that stocks have a positive relationship with gold. So when you kind of put this all together, what you end up with is there is no predominant relationship. Sometimes it's M2, sometimes it's inflation, sometimes it's the dollar, and sometimes it's the stock market. So if you look, M2 has been negative to just slightly growing. That should be bad for gold. CPI has been coming down now for 1.5 years, 2 years. That should be bad for gold. Real rates are very high. They're starting to come down, but they're very high. That's not good for gold. And the dollar's kind of been range bound, and if anything, increasing a little. So that too is not necessarily bullish for gold. So you got all these factors that have proven very helpful in the past are not adhering to their relationships, but stocks and gold are. So that kind of leads us to the place of gold is caught in what you called it, what, Lance? The everything bubble?
The everything bubble, yes.
The all in the pool bubble?
Yes.
It's running up on speculative fever that's going on in a lot of asset markets, Bitcoin as well. And we did one other thing in this. We created what's called a multiple regression. So we took those 4 economic factors and we said, okay, take the 4 and you kind of combine it and compare it to the price of gold and tell us what's the relationship and what's the most important. And when you do that, the relationship wasn't that strong. But what was interesting, not necessarily surprising, but interesting, was that real rates are very correlated, or were far and away the biggest driver of gold within the multiple regression. So again, real rates are very high right now. The rate of interest over inflation is high, and it's growing because inflation is slowly coming down and rates are actually going up. That should be very negative for gold, and it hasn't been, right? A conservative Fed, which they have been, should not be good for gold, and it has been good for gold. So, you're kind of left with this period where none of the economic factors are working. What is? And it appears to be speculation. So, gold buyers run the risk that when the speculative fever kind of dries out, when it ends, that the fundamental factors aren't backing the gold price where it is today.
So I mean, and again, we've shown the technical charts on this before, and just it's been, and look, there's we have a portfolio just clear that owns gold. I think about 7, 8, 9% of the portfolio is gold right now. So that portfolio has done exceptionally well this year, but just like with anything, every asset price has a range. And, ultimately the deviations from long-term means are so extreme right now on a monthly basis. And you don't normally get such extreme deviations on a monthly basis because the data is so long. But you have extreme deviations on a monthly basis. That it doesn't, and again, when you're talking about monthly data, it doesn't mean that you're going to get oh my gosh, I got to sell everything today. But this is, you're clearly getting into levels that have historically led to either very long periods of consolidation and correction, or very big sharp drops in valuation or in prices. And we've seen this repeatedly throughout history, 5 other times going back, 50, 60 years. So I think it's something that investors really have to look at, is that the speculative side has now detached from the underlying fundamentals. And it's interesting because, people complain about the stock market, right? It's like, oh, look at valuations on stocks. I don't want to own stocks. Look at the valuations. But it's the same exact thing that's going on in gold right now, that, if you can build a fundamental analysis around, the value of gold relative to the dollar M2, those type of things, you have to look at that detachment from those underlying fundamentals and say, they're overvalued, right? And I think that's the hard part that people have to deal with, because again, we get tied up into these theses and these kind of fear-driven narratives, and at the end of the day, it's just about price, because that's all that drives gold, which is people buying or selling it.
And you can also take the other approach, Lance. You could say, well, maybe gold's predicting what's going to happen.
Sure.
So let's talk about that. So the dollar has a very strong negative relationship, right? So the dollar, so basically the gold is saying the dollar is going to collapse here. The dollar soared yesterday on Trump's election. You could say that real rates are going to come down sharply, that the Fed's going to cut rates all the way down to nothing, and that the whole bond yield curve is going to collapse. It's just all going to drop. Doesn't seem like that's really happening either. So, some of the key factors that drive gold those forecasts don't seem that logical right now. Maybe they will be, but it seems like a stretch. And, again, I think it's speculative. And again, it can continue, and it probably will continue.
Right.
But it's getting very detached from its fundamentals.
There you go. All right, wraps up the show for today. That article on the website, if you want to read it, it's all there. Again, we publish all of our research online, so this is stuff we're looking at when we manage our portfolios, evaluating risk, those type of things. It's all on the website, realinvestmentadvice.com. It's there for you. Check it out. If you have questions or comments, send them our way. Just click the Ask a Question button. Happy to do it. Have a great day. Danny Ratliff, Richard Rosso here tomorrow for Financial Fitness Friday, and I'll see you back here on Tuesday, because Monday we're not here. It's the holiday. So We'll be back on Tuesday. Have a great day.